Financial gurus will hate me for making this video because I'm gonna show you for free how you can save up to $59,000 after taxes by investing your money at 4.5% than by paying off your mortgage early that carries an average interest rate of 6.5%. And unlike those gurus out there who are just telling you, I'm actually gonna show you a complete decision making process step by step with examples and calculations that otherwise would cost you thousands in consultancy fees. Plus, I will be giving you a free template, so by the end of this video, you would be able to easily decide whether it's better to pay off your mortgage early or invest your money in a savings account, mutual funds, or other financial markets. So let's get straight to the point, and let's say that you are buying a house worth $500,000 with a 20% down payment, which means that you are borrowing $400,000 from the bank. That is basically your principal loan amount, and you get this standard 30-year fixed rate mortgage for which the average annual interest rate according to the official Fred website is around 6.5%. So I will just use that rate. Plus, you are paying say $250 in taxes and $80 in insurance every month respectively. I will leave extra payment for now, and we will come back to this again later in this video. And as soon as you put your values in my template, it will automatically calculate your monthly mortgage payment with taxes and insurance. Note that this monthly mortgage installment includes both the interest and principal amount, and in a moment we will see how to separate them. Next step is to develop a mortgage amortization schedule, but we are not going to waste our time on that because I've already automated this for you. All you need to do is to put your values in this template, and once you have done this, just go up here and you have this button called generate. Simply click on that button and it will automatically generate your mortgage schedule. Now you can scroll all the way down to verify that it has accurately calculated everything, and our closing balance is 0 after making the last payment. Plus, you have got this complete breakdown that separately shows interest amount, principal repayment, taxes, insurance, and the opening closing balances so that you can easily understand this table. And now that we have generated our mortgage amortization table, we are ready to move on to the main part of this video. That is to decide whether it's better to pay off your mortgage early or invest your money, say in a savings account or mutual funds. And we will do this in two simple steps. In step 1, we will compare how much interest we need to pay if we are not paying off our mortgage early versus the interest we would pay if we are paying off the mortgage early by making extra payments. In step 2, we will compare the interest we have saved by paying off the mortgage early with the interest we have earned by investing that same money. Let's do step 1. So we have got this mortgage schedule telling us that we will pay a total of $510,000 in interest without extra payments. And on the next sheet here, I've got this comparison table. So I'll just put that interest amount in this without extra payment column just like that. Now in step 2, we want to know how much interest we would save if we are trying to pay off the mortgage earlier by paying an extra payment of, for example, $400 each month. And you can do this in a second with this automated template that I will link to in the description of this video. All you need to do is to come to this extra payment option and simply put your extra payment amount here. Then hit the generate button again, and it will instantly regenerate your mortgage schedule with extra payments. Let's scroll to the end of this revised mortgage table, and we can see here that after making an extra payment of $400 a month, we will be paying $330K in interest as compared to $510K that we were paying without extra payments. Plus, we will also pay a total of $100K as an extra payment if we pay off our mortgage early. Now I will go back to my comparison table again and put both of these values, i.e. total interest plus the total extra payment, in this early payoff column just like that. And finally, we want to calculate how much we would earn by investing this same $400 every month in a savings account instead of paying off the mortgage. So let's go to the official website of Fred to see the interest rate for a personal savings account, which is 4.8% right now. But let's just be conservative here and use 4.5% instead of 4.8%. Let's come back to this comparison sheet again and calculate the future value of our investment after 30 years with a constant monthly investment of $400, and the result is $304,000. And since we are investing $400 each month for 30 years, so our total investment would be 400 multiplied by 360 months equal to 144,000. Deducting this from the future value of the investment returns 161k, which is our net savings if we were investing our money instead of paying off the mortgage. Let's quickly compare this with the mortgage payoff option. So we have saved 80,000 if we paid off the mortgage early and 161,000 if we have invested our money. So in total, we have saved almost $81,000 by not paying off our mortgage earlier. However, we still have one final piece left in this puzzle, and that is the taxes. We know that we have to pay tax on the profits we earned on our savings account and report them on Form 1099. And in our case, the interest earned is $161,000. Normally, for this amount of interest, you will pay around 24% tax. But let's just go to Forbes, which is a highly credible website, and here we can see the federal tax brackets for savings account, which in our case is 24%. And we can also verify the same from Kiplinger website as well. So let's come here on this final decision working, and I will deduct 24% tax from the net profits of 161k that we have earned by investing our money. And after deducting the tax, our net savings from the investing option is around 122,000. But what will happen to this early mortgage payoff option? We know that we can deduct our mortgage interest to reduce our taxable income. But what will happen if we pay off the mortgage early? Let's go through a quick example to understand this. Suppose that your taxable income before deducting mortgage interest is 100,000 and you have paid 25,000 interest on your mortgage during the year. So you will deduct that interest from your income, and now you will only be paying tax on the remaining 75,000. But if you have paid your mortgage early, you don't have any interest to claim, so you will be paying tax on this full $100,000, and as a result you will lose that tax benefit. Similarly, in our case, we will also lose the tax benefit on this $80,000 that we have saved by paying off the mortgage early. Assuming a 22% tax rate, I will deduct tax benefit lost from this $80,000. And finally, now we can see that after adjusting for the taxes, we are still saving around $59,000 if we invest our money in a savings account instead of paying off the mortgage early. Now, if you play a little smart here, you can actually save all those taxes by investing your money in, for example, an IRA account or other interest-free products. But even if you don't do that, you are still saving $59,000 with investing option. You can also choose to invest your money in a stable mutual fund that could earn you around 10% or 7% after taxes. And in that case, your savings will be like 3 to 4 times higher than this amount. Conclusion: it is better to invest your extra money in a stable mutual fund instead of paying off your mortgage early, and in most of the cases it will save you substantially higher amount of money as compared to the mortgage payoff option. And if you find this video useful, please like and share, and feel free to share your thoughts in the comment section. Also consider subscribing to AIC Certified Accountants for more videos like this. Take care and see you in the next video.